Barry, we're still trying to get those slides loaded up. It'll be just a minute, so we aren't going to start your
Okay.
timer until then. If you want to give us kind of a preview of what we're looking at, though, feel free.
Okay, yeah. Yeah, I actually see some of my others in here, which is great. And then when you get it loaded up, let me know what the name of it is, since they're listed alphabetically, so I can find it quickly and respect everybody's time and get to it here real quick. So yes, today I'm going to talk about timing the market, which is obviously our topic today. And I'm going to talk about cycles, different types of cycles. So this will be an overview, an introduction to various types of cycles. When we think of cycles in the market, I think most people think of the fact that the market, it oscillates. When the market goes up, it doesn't go straight up like a straight line. It actually wiggles up. And when it goes down, it doesn't go straight down. It kind of wiggles down. You get highs and lows. You get oscillations like that. And that's what most people think of when they think of cycles. But there are other types of cycles, of course, and some of you are familiar with those other types of cycles as well. So we're going to talk about several of those different types of cycles and how they can help you time the market in various ways. I will say this also ahead of time, that cycles are fantastic. They are amazing. Timing the market is so important. You know, a chart is a two-dimensional object. We've got price on the right, we've got time on the bottom. And so time is half of the information on the chart, fully 50%. And so, but as I've mentored students and I've had people come into my office and they bring their laptops and I look at their charts and I see what they have. And so many people, especially the amateurs, oh my gosh, I look at their charts and they are so confusing. They have such information overload on there. Got way too much information. It's crazy. And so that's one of the differences I've noticed between amateurs and professionals, by the way. And the slides are coming, guys. So they're loading the slides up. They're not loaded up yet. So I'm just starting to talk here a little bit before the slides are coming. But they'll be there. They'll be there. So anyway, as I look at the amateurs, we'll call them amateurs to be nice, basically people who aren't making money yet, I look at their charts, they are just filled with too much information. Indicators and lines and moving averages and wiggles and jiggles and arrows and dots. It's like, oh my gosh, information overload. How can you possibly have clarity with so much information on your charts? And yet, even with all that information, very few of them have any type of timing tool. And it's crazy. You got all that stuff on there about price and you don't have any timing tool? Seriously? Again, that's 50% of the information on the two-dimensional object we call a chart. And in fact, of those two dimensions, the famous trader W.D. Gann once said that time is actually more important than price. So they're missing out. How can you establish a probability scenario, which is really what trading is all about? It's about establishing probability scenarios because there's no certainty in trading, right? You can never know for sure what's going to happen in the market because you can have the odds on your side, you can have trades that have worked 99 times out of 100 before, but you know, some dramatic news comes across the news wire, some surprise, and the market's just going to do whatever it's going to do. It's going to have a knee-jerk reaction. And even if the news isn't true,
Excuse me,
it could
Barry.
just be a gossip or a rumor. Hey, there's our slide. Great. All right. Thank you very much. Looks like we're all set. Thanks. I appreciate it. So, yeah, even if it's just gossip or a rumor, the market's just going to do what it's going to do. So the best we can do is establish probability scenarios. So I just want to say always, always, always use risk management. Hedge your positions, you know, use stops, things like that, because the market is not a domesticated animal. It's not your pet. It's not something you can control. It's a wild animal. And so always, always, always be managing your money, use money management techniques and risk management techniques. Okay, let's jump right into it. I'm going to be sharing with you at the end of this presentation a special offer which is free, not selling anything today. I'm just giving everybody a free 5-day video correspondence course that I put together. And that's 5 days of video instruction with interactive quizzes at the end of each video. So absolutely no cost to that whatsoever. And I'll be giving you the website for that at the end. A little bit about my history. I don't want to go into this too much because our time is limited and you're here to learn about timing the markets and not about me, but still, it's important for you to know a little bit about who's talking to you today. And my father was a trader. It was his avocation. He was primarily a stock trader. It was his passion in life and a passion that we shared. So I grew up learning about trading when I was knee-high to a grasshopper. And I've just been around it all my life. It's basically in my nervous system. I was a member of Worldwide Traders, then known as Day Traders USA. That's where I got a lot of my education by being a part of that group, that trading club in Orange County, California. It was a tremendous, tremendous experience. We had different speakers come in every other week, and so I got exposed to a lot of different things, a lot of great traders. Tom Busby came down many times and was always fantastic and learned so much from him. Hired many other mentors and teachers to work with me as well. Hired private mentors to work with me one-on-one. Went down to the Chicago Mercantile Exchange, worked with a former floor trader there, got an apartment, and oh my gosh, that's where you really learn. You go down there, and because us screen traders, we start to actually think that the indicators are the market. And they're not. They're not. You go down on the floor and you see what's going on there, and you realize, oh my gosh, the market's totally different. It's people. It's buying, it's selling, it's bids, it's asks, it's emotions, it's people's research and their logic, and oh my god, and it's institutions, and wow, it's human beings and what they're thinking, feeling, and how they're reacting to things for whatever reason. I was the lead moderator at futurestalk.net, open and close the market every day. And then I got a doctorate in hypnotherapy and certified in neurolinguistic programming so I could help people with the psychology of trading. I've been featured in several published books. Oh gosh, I could go on, but again, let's not belabor the point here. Anyway, I've been around the trading world for quite a while. What I do, I want to introduce my methodology real briefly, just give you a quick overview of my methodology to show you how timing the market and cycles fits into it. What I do in my methodology is summarized in this. I define the energy in the charts. Okay? I define the energy in the charts. So what are these energies that I'm talking about? Well, there's 5 that I look for in every single potential trade opportunity. The first one is trend. And trend simply means direction up or down. So first I want to establish, okay, do I believe the market's going up or down? What's the indication right now? What's the energy in the market right now? Number 2 is, okay, let's say that the trend is up. Well, what's the strength of the trend? And that's defined as the energy of momentum. That's energy number 2. We want to trade strong trends, but not weak trends. So we'll only trade trends that have momentum behind them. And then the third one is cycles, and this is what we're going to focus on today. But again, I want to show you how cycles is just one part of my entire trading methodology. I don't trade cycles in isolation. I trade them as only 1/5 of my overall methodology. And that, as I say, is timing highs and lows, but we're going to talk about some other type of cycles today too. The fourth energy in the charts is support and resistance. Very important. Support resistance is something that almost all traders use, and boy, if you don't use it, you're missing out on something for sure. Because so many people respond to these price levels, so you better know what those price levels are that other traders will be responding to. And I define this as a blockage of energy. It's a blockage of the first 3 energies. And then finally, the 5th energy and the last energy that I use on every single trade. And by the way, there's other energies, but these are the 5 that I use on every single trade. And that's the fractal energy, and that's just a fancy schmancy name for using multiple time frames. So, and again, a lot of traders do this. I do it differently than most. Most people look for the trend on the next higher time frame. I don't do that because that's a lagging indicator on a slower chart, so that doesn't make any sense to me to do it that way. But I do use multiple time frames, so if I'm trading, say, a 5-minute chart, then I would also consult a 15-minute chart. Or a 1,000-tick chart, I'd consult a 3,000-tick chart. A daily chart, I'd consult a weekly chart. So that's what I'm doing, and I'm basically saying, okay, how many of these energies are all aligned at the same time, all saying buy or all saying sell? And I use instruments to measure the energies. So for trends, I use a moving average. For momentum, I use a momentum index. We use previous cycle highs and lows, previous wave highs and lows, floor trader pivots, Fibonacci, things like this, previous days, high, low, close. And for fractal energy, as I indicated, I use a chart interval generally 3 times that of the setup chart, such as a 5-minute chart and a 15-minute chart. So then we use this to define a probability scenario. As I said, at each point we ask how many of those 5 energies are aligned, all saying buy or sell. And then we simply give each setup a score of 1 to 5 based on how many of those 5 energies say buy or sell. The higher the score, the higher the probability. I kind of liken this to taking each trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. And that's the key, is that these 5 energies are all independent of each other. I don't use 3 trend indicators. I don't use 4 momentum indicators. That's redundant. And frankly, none of these indicators by themselves means a hill of beans anyway. None of these indicators really mean anything. They're not going to help you make money. People put way too much emphasis on indicators, in my humble opinion. So the only reason that there's any significance to this at all is when they all agree, because they're measuring different things, because they're measuring independent, uncorrelated energies. When they all agree, saying buy, or all agree, saying sell, well, now you have a edge. Now you have a probability scenario. Okay, still not a certainty, but a probability scenario. Puts the odds on your side. So that's basically my methodology. I'm just giving you a quick overview of that today. And again, the main focus of me sharing that with you is to let you know that talking about cycles, as we're going to do now, is just 1/5. It's only 20% of my overall trading methodology. I don't believe we can trade cycles in isolation. They are not the answer. They are not the Holy Grail. Nothing's the Holy Grail. Successful trading comes from putting together a combination of factors to establish a probability scenario. Okay, so let's go and focus on cycles here today. And in doing so, as I said, a chart is 2 dimensions, time and price. Most people use only 50% of the chart. And so what happens is people say, oh my gosh, I got into a position and then I got stopped out. And then after I got stopped out, the market turned right around and made a major move in the original direction of my trade. My floor trader friend that that mentored me, he said retailers are often right, but at the wrong time. And that is so true. And that's what happens if you don't have some sort of timing tool, is that you might be generally right about the direction of the market. But the question is, when is the opportune time for your entry? And without that knowledge, you're going to get stopped out and you're going to have a hard time making money. So there's many types of cycles. And again, today I just want to give an overview on some of these different types of cycles that can be used in your trading. So here, let's start with just a list. First of all, we'll talk about seasonal or calendar cycles. And then we'll move on. We'll talk a little bit about volatility cycles. And then one that's very interesting that I don't hear a lot of people talk about, which is the order chaos cycle. That is very important. And then we got about coupling and uncoupling cycles. And finally, the up-down cycles that most people think of. Okay, so let's go through them one by one. First one, very common cycle, very well-known seasonal or calendar cycles. I'm not going to spend too much time on this one because, again, it's talked about a lot, but we have people from all different backgrounds and different levels here today in the room, and so we'll address it. The most natural or easy to understand of the calendar or seasonal cycles is probably the agricultural markets. You know, when you grow crops, you sow in the spring and you reap in the fall. And so there's a play to be made there where you could say, okay, if you're going to trade the ags, then you can, you know, place your positions before the spring, and then when the great harvest comes in the fall, then you collect all your big money. And people who, farmers and so forth, you know, they use futures in order to lock in certain prices. And that's a way of managing their risk, because while that cycle might seem easy, it's not, because all sorts of horrible things can happen during the growth cycle. I used to live in Florida, and so I followed the orange juice market. And, you know, they'll grow a lot of oranges in Florida, obviously. And it was always big news in Florida when there was a freeze. And then, oh my gosh, you know, there's a freeze and the oranges are not coming through and there's going to be a shortage of oranges this year. And of course, that would make a dramatic spike in prices because of supply and demand. Very little supply, but still the same demand. So it's not as easy as sow and reap, because all sorts of things can happen during the growing season. The retail sector is another very obvious one. Many retail merchants make most of their money during the Christmas season. It's one example. In fact, make all their profits during the retail season, and the rest of the year they're just basically staying in business. So again, if you watch the news, you watch CNBC or whatever, they're always talking about expectations for the holiday season. They don't use the word Christmas too much anymore to be politically correct, but whatever you think of that, they do talk about the holiday season around December 25th, which just happens to be Christmas. But Hanukkah's involved, obviously, and that is, regardless of what people's religious affiliations are, that is a huge part of the economic cycle. And again, travel, mostly for spring break, around Easter time when kids get off college, and the summertime especially. So any stocks that are involved in the travel industry, usually they get more sales during the summer. But again, it's not that easy. It's always a play, right? It's always something that you watch, and then you have to say, well, does it look like what's the economy like? Do people have more discretionary spending? Will they be traveling? What's the price of gas? Can they afford to drive? Are airfares going to go up? All these kind of things come into play during those times. So these calendars these seasonal and calendar cycles are not always consistent. You have to be able to read a chart and not just trade the calendar. But there are times that you look at the type of stocks that move around these times. So it's more of a stock selection issue, I would say. And again, it's just one of the energies. Now let's talk about volatility cycles. Volatility cycles are really, really fun and powerful if you trade them correctly. I call this the X-Con trade. It stands for expansion, contraction. Markets go through cycles where they have wide range of movement in a very short period of time, and then narrow range movement, where the market, and you'll read in chat rooms, people say, well, the market's just doing nothing. It's just sitting here going sideways. Markets, you know, and people get all distressed and freaked out. My gosh, you read comments in these chat rooms, and it's actually, I find it kind of humorous now. And one of the most common comments that people will say is, oh man, S&P is not going anywhere. It's just, you know, churning. and it's just going sideways, and they'll sit there for 2 or 3 hours and they say, you know what, this market today is not going anywhere. I'm playing golf. I'm going to play golf. I'm out of here, and they leave. That is a really great indicator. It's kind of a sentiment indicator, because just by the time all the retailers go off to play golf and have given up on the trading day, that's a pretty decent indicator. Again, just an indication, not a certainty. I mean, all indicators do is indicate anyway, right? They only do what they promise, indicate. They don't tell. And by the time they all go play golf, well, that's when the market takes off and starts making all kinds of great moves, and you can make all kinds of money because people have it backwards. So what people often do is they will scan for high volatility, high beta stocks, and they're looking for big moves, stocks that are really moving. Well, the problem with that is, quite often, by the time a stock or any market, whatever it is, futures, forex, whatever you're trading, is in a high volatility mode, and it's in that long enough to show up on the scan for the formula to really crank that through whatever look-back period it's calculating, well, then the market is about to go into a low volatility cycle. And so they're always trading it backwards. So I prefer to trade for low volatility and looking for the new high volatility cycle to begin. Now, the only caveat on that is that you have to make sure that that market actually does have high and low volatility cycles. There are some markets that just have very narrow ranges as part of their characteristic. So obviously you want to avoid that. So you just look back at historically and make sure that that particular market does go through those cycles. So if you scan for high volatility markets to trade, you're often getting in right before contraction sets in. So I'd rather trade inside of contraction. I like to trade things like triangles and wedges and different things like this. Bollinger Band squeezes, these are some of the examples that a lot of you are familiar with. Also during the day, there's a volatility cycle that occurs just naturally during the day. Generally in the morning we have high volatility. In the afternoon we have high volatility. And then midday is lower volatility. Now, we see some changes in this because everyone is so used to this that we're starting to, some days you'll see some really good moves at lunchtime. And the reason that happens is because just by the time everybody gets used to the market behaving one way, it starts behaving differently. So it's certainly not every day, but I have found some of my best trades during lunchtime when everyone is supposedly gone and sleeping and not watching. Now the next cycle I want to talk about is the order chaos cycle. There's two main philosophies around this. There's one that says, well, the market's just a complete random walk. And of course there's the famous book, Random Walk Down Wall Street. And that means that the market's chaotic and there's really no way to make money in the market because it's unpredictable. And then there's another school of thought that's the exact opposite. And these people say that the market is perfectly orderly and perfectly predictable. And you'll hear people make claims that they have predicted the price of the market, 12 years out into the future to the exact day and time. Well, to me, these are both rather extreme views, and as is often in life, the market or the truth is somewhere in the middle. Both views do have merit. Both do have some truth to them, but at different times. And that's what I noticed as I studied both of these schools of thought. They seemed very convincing. I mean, they have good arguments behind both of them. And so then I thought, well, how can they both be true? And it was true because they're true at different times. And so that means there's a cycle. Sometimes the market is chaotic. Sometimes the market is orderly. During chaotic cycles, there's no probability scenarios to be had. During orderly cycles, there are. And this is why overtrading is the cardinal sin. Because you can't just sit there and trade all the any market anytime you want to. Because you have to only trade during the orderly cycles, not the chaotic cycles. And the way I do that, of course, is, as I already said, I wait for the alignment of the five energies. I personally, in my method, define An orderly market as one wherein the 5 energies all align saying buy or all align saying sell. Then I say, okay, now we have a high probability of being in an orderly market. Things are aligning. Usually what's happening is professional money's coming in. There are people who commit to positions for a period of time. They're not like retailers where they're skittish. They're in, they're out, they're scared. They're trading their little one lots. These are people who put money behind it. They put conviction behind it. If the position works out, they add to it, and it creates an orderly market that actually follows through. Then the other cycle that we'll talk about here is the coupling and uncoupling cycle. When we talk about the market, most people use the S&P 500 as the benchmark. And so then we compare other sectors, industries, countries, currencies, commodities, interest rates, all these different types of markets, how they couple or uncouple with the equity index from time to time. In other words, if the S&P is going up, is whatever, the commodity going up, is the exchange traded fund for India going up, are biotechs going up, are bonds going up? People think, oh, bonds and equities trade inversely. Not always, not always. And so what we do is we look for, are they trading with or against the S&P? These cycles can provide some key opportunities, but the key is to catch the uncoupling early. You watch for them trading together, and then you look for the other market to start to uncouple. And if you can catch that early, quite often that will be a very, very good trade. It's a relative strength trade is what it really is, and it's a way of attempting to outperform the S&P. And finally, we have the up-down cycles. Markets tend to make bigger and spend more time in the direction of the trend, and smaller price moves and less time against the trend. Up-down cycles have to be combined with volatility cycles, and so they expand and contract. Up-down cycles combined with order chaos cycles. So we don't just trade every retrace because the market's down, because it could be during a chaotic cycle. And then we also combine it with calendar cycles for even better timing. So here's an example of an up-down cycle. The market goes up, and then it retraces. As it's going in the direction of the trend, it spends more time and covers more range in the direction of the trend. And here again, just showing the oscillations. The market's going up, it's in an uptrend, but it's wiggling up. And so the key is buying one of these retraces, buying a low, buy low, sell high. So, to summarize here, high probability trading, everything works sometimes. There's so many ways you can trade that can be effective, and they will all work sometimes. On the other hand, nothing works all the time. So with your money on the line, you want to know, will it work this time, or are the odds are that it will work this time, is how that really should be phrased. So I wait for the alignment of the 5 energies to put the odds on your side. And here's what I'm doing. I'm looking for trend. That's energy number 1. That is strong, has momentum behind it, energy number 2. At the right time, it's energy number 3. That's where our cycles come in. With support and resistance at our back, we want to buy off a floor or short off a ceiling. And then finally, energy number 5, confirmed by the bigger scale. That's the next higher time frame. And again, I don't trade in the direction of trend on the higher time frame. I trade in the direction of momentum on the next higher time frame. And so here's just an example of what it would look like on my chart. You can see my charts are pretty simple and clean. We've got a new trend. Price is going above the 50 MA for the first time. Momentum's the indicator on the bottom. It's holding above 0. We've got a cycle low. We've got support of the 50 fib. And on the next higher time frame, momentum, the indicator on the bottom, and cycle are up. That's a 5 out of 5 trade. It's very robust, very adaptable. It works for stocks, commodities, options, currencies, futures. I trade all that stuff. I invest, I swing trade, I day trade, and I use the 5 energy method for all of it. It's simple. We're just scoring 5 energies. So here's the free offer that I have for you guys today. Just go here to this URL, topdogtrading.com/free_course.html. Don't forget the underscore between the words free in course. And you go to that website and you get my free 5-day video correspondence course with my 5 videos, the interactive quizzes. Oh, and on day 4, I'm actually giving one of my favorite trade setups. One of my favorite trade setups, absolutely free, with all the rules and the filters on the 4th video. So there you go. Thank you very much. I hope you enjoyed the presentation and that you got some good things out of it and learned something new about timing the market and about cycles.
All right, great. Thank you very much, Barry. We appreciate you taking the time to be with us today. Excellent job, as usual. We've had Barry on a couple times at the TradingPub, and he never disappoints. So definitely be sure to take him up on that. It's topdogtrading.com/free_course.html. And we had a request for this for someone had asked us to post a copy of all 3 of the links, the special links that were offered. And you should be able to, I'll say this, you never know with technology, but you should be able to click on any of those links to take advantage of the offers. We'll leave this up for about 2 minutes, and then we'll shut the room down. But again, definitely be sure, I'll type this link in the chat area for Barry. It's topdogtrading.com/free_course.htm. So again, you can click on that link to get the free video course. We appreciate you guys being with us today. I hope that you enjoyed the event. We try to host these events about once a month, one of these really big events. And let's see what, and give you a second real quick. Just get a little bit of your feedback here. We always like to hear your feedback on that. So if there's anything that we can do for you, we did record the session. And again, we'll get a copy of the recordings posted. We'll post the copy of the recordings to our website. If you want to save this link, I'll type this in. I'll type this link in if you want to save the link. But it'll be posted to our website under free education. What we do with the recordings, we break them each down per presenter, so you can watch each one as an individual session. So again, great job to Tom and Guy and Barry, and you can click on those links right there and take advantage of the offers for everyone. All right, everyone, does anybody have any questions for us? We'll also try to post a copy on our Facebook page, which is right here. If you're one of the billion people in the world on Facebook, hopefully you're on Facebook, but you don't own the stock. So, but we'll post a copy on the page right there. All right, good deal, good deal. Julie asked a question, when will the recordings be ready? Hopefully, we hope to have them by this afternoon, so we're going to work to kind of get them out pretty quick. I know that we have a lot of people that wanted them, so hopefully they will be out this afternoon. All right, well, our next event at the TradingPub is going to be tomorrow morning, actually at 10 o'clock a.m. We've got a special options expiration session, so hopefully you guys can join us there, and I'll type in the link for that. It's just tradingpub.com/events, and we hope to see you there tomorrow. Thanks, everyone. We'll get the email out to everybody with the recording later this afternoon.